this first day of the trading week, currency markets will be responding to Friday's NFP data. Valentin Marinov of Citigroup joins me now for a look at what we can expect from the G10 pairs. Valentin, G10 currencies continue to react to the news that US businesses added 195,000 jobs to the US job market. But what other drivers can we expect for the G10 pairs this week?
This week, the markets will focus on the Fed speakers. We have among them Chairman Bernanke, as well as the release of the June Fed minutes. In particular, investors will want to know whether the Fed officials will want to lean against the latest backup in U.S. yield on the back of the quite supportive non-farm payrolls data last week. I think that there may be some effort by the Fed officials to distinguish between Fed tightening and Fed tapering. Really, Fed officials endorsing more that Fed tapering will come before long, but potentially leaning against the latest backup in short-term yields. While this could represent a mild negative for the dollar, it is likely to be only a temporary negative, with investors looking to buy dollars on dips. And importantly, if indeed the Fed officials continue to signal that tapering is coming before long, all that should keep the dollar rather supported across the board.
The single currency dipped to 6-week lows against its US counterpart on Friday. Heading into the new trading week, this pair continues to be tied to expectations that the Federal Reserve will soon commence tapering. How is this priced into your forecasts for this pair over the short, mid and long-term period?
We remain bearish euro-dollar, and while we recognize that some negatives seem to be in the price of euro-dollar, these are mainly dollar positives. That is, the market is already expecting tapering to come in September, and presumably the Fed to exit QE but by mid-next year, given the very positive U.S. data. What the market does not seem to be pricing in is further easing by the ECB down the road, which will coincide with the more neutral stance adopted by the Fed in coming months. In particular, we expect the Governing Council to deliver another cut of the main refinancing rate before year end, and then consider more unconventional policy easing measures in early next year, like negative deposit rates and presumably even QE. All that should keep the risks for euro-dollar on the downside, and we expect that downside to continue towards 125 in 12 months.
Shifting over to the pound US dollar, and the pound is yet to make up gains from last week's Bank of England meeting. The overall picture on this pair currently remains very bearish. Do you anticipate a trend reversal anytime soon?
Well, not really. We remain bearish sterling against the dollar. Similar to euro-dollar in the case of cable, we have seen some dollar positive in the price, so that heading into the Fed speakers and the Fed minutes this week, we may see some scope for consolidation in cable. That said, we think over medium to long term, cable is still a sell. We see the arrival of Dr. Carney at the helm of the BOE as an indication of further aggressive easing by the Bank of England. Forward guidance may be unveiled as soon as August, but importantly beyond that, we think that the BOE will continue to lean against the backup in gilt yield, and this may involve additional bouts of QE. In the past, this divergence between the dovish BOE and the more neutral Fed has resulted in lower cable. And in terms of target, we think 145 for sterling dollar could be on the cards in 12 months.
And lastly, taking a look at the US dollar Japanese yen. This pair will be trading on Wednesday's US FOMC meeting minutes and Thursday's Bank of Japan rate decision. But looking into the longer term, what can we expect from this pair?
I think that the uptrend for dollar yen is here to stay. We expect 110 to be within reach in the next 6 to 12 months. The reasons behind that call remain the same. Really, the aggressive dovishness of the BOJ is here to stay, whereas the Fed is going to become even more neutral and ultimately exit QE by mid next year. Importantly, going into the BOJ meeting on Thursday, we think that the Kuroda and his colleagues will continue to reassure the market that they will stick with their aggressive monetary easing. This could prove supportive for Japanese equities, but negative for yen. The link there being that foreign investors that are bullish on Japanese equities tend to hedge that exposure by buying dollar yen or sell yen against the dollar. So as long as that link really persists, the positive link between Nikkei and dollar yen, we remain confident that more upside could lie ahead for dollar yen. And as I was saying, really we expect further gains towards 110 in 12 months.
Valentin, many thanks for your comments. Elaine Stenson will be taking a closer look at the pound tomorrow, so for all the latest on that story and more, stay tuned to Dukascopy TV.